Greetings from Ambit GPC. My name's Sunil. Let's get started by taking a quick look at equity markets. So the Indian markets have had a very strong last 10 days or so. And as a result, we were now anywhere between 13.2% and 19.7% from the trough date being March 4th, 2025. Markets have done well. In particular, the mid caps and the small caps have rallied strongly, and we'll get into the reasons why. Looking very briefly, U.S. markets have also, in fact, have had a better month than Indian markets and have recovered most of the losses that those markets experienced over the last few weeks. Now, looking at the current rally, we usually like to take a look at how the rally parameters are faring versus prior rallies. And so one of the parameters we look at is whether it's tracking within the ranges. And so the current rally is the thick red line, and we're into day 48 of the rally. And it's tracking right within the pack. It's tracking with 2016. It's tracked with 2022 and arguably or very close to 2004 and 2013. Now, three of those years, 2016, 2013, and 2022, preceded years that had significant rallies in the Indian equity markets, and so we hope that is how things pan out. Coming to Europe and Asia, Europe's holding up fairly decent performance year to date, in particular for the European markets, driven by Germany and by Italy and by prospects for increased infra and defense spending. But what we really want to highlight is the Chinese market and the Taiwanese market. Taiwan, very highly correlated with US tech stocks, has also recovered very well and has recovered much of the losses that market experienced. Now, the Chinese market was being touted as a market that was extremely attractive on a valuation basis and was seeing significant catalysts that would drive the market higher. And maybe that would have panned out, but right now the market has not delivered in line with other markets we just noted, and has been an underperformer for a variety of reasons, domestic as well as tariff related. Coming back to Indian markets, we'll start with the sectors that are underperforming and holding back the Nifty's performance relative to the smaller mid and small caps. In particular, it is the IT sector, and the IT majors in particular have not delivered results that would bring investors to put in new monies, and pharma continues to be held back by concerns around tariffs, regulations, and pricing. And so those are the issues in those two sectors that are lagging the broader index. What's leading is defense by a large margin, 47.4%, relative to the Nifty 13.2%. So defense has shot through the roof. Alongside defense, the other sectors that are doing well: autos, infrastructure, and energy, and then the financial pack. Again, the financials led by PSUs doing extremely well. Looking at commodity markets, commodities bounced back marginally. And so year to date, 3 months, and even 1 year, there's nothing to be too concerned about in terms of a pickup in commodity inflation. What we'd highlight instead is that Brent seems to have bottomed in the high 50s and is now roughly in the mid 60s. And that is what one would expect given the business cycle and how crude tends to be a lagging asset class relative to equities. And so that gives us some additional confirmation in terms of the equity bottom and how the market is, how the different asset classes are working their way through the business cycle. Coming to fixed income, the rates continue to decline, and credit to the government for their efforts in getting the bonds, our country's bonds, listed in global exchanges. That has certainly been a huge catalyst in terms of inflows. alongside other factors such as inflation coming down. And regardless, the entire curve is moving lower, or the 1 year and the 10 year both showing drops of over 125 basis points over just the last 12 months. And only some of that had occurred at the beginning of the prior quarter. Looking at the global picture, lots happening in the US, in Japan, and Switzerland. Those are the ones we'll highlight, although one could also highlight the UK. The point being that we've seen a significant tick up. The Japanese 30-year and the Japanese 40-year are now at rates on yields that haven't been witnessed in at least the last 20, 25 years. So significant highs and significantly alarming in terms of what that says about the Japanese economy, as well as the Japanese bond market and debt. And the similar concerns are being flagged by the US bond market, particularly worries we would guess around the additional tax and spend bill and the rising debt and the inability to really control deficit spending and control interest payments. And so we're witnessing rising yields in the bond markets in the US, and contrast that with negative yields again in the Swiss 1 year, 2 year bonds, which is reminiscent of what we witnessed, I believe, in the early years in the pigs of the 2010s in the pigs crisis. Coming to gold and precious metals, we'll talk about these separately later. But gold, we continue to believe, despite the recent sell-off, we continue to believe it holds its place as a strategic asset. We went overweight gold in April of 2024, and we continue to hold our position in gold, particularly given what's transpiring in the various developed markets and the rising debt and potential for crisis that exists in those economies. And the final I'd want to look at is the dollar index, which has weakened but has stabilized at the 100 levels, which pretty much is long-term support. Coming to earnings, we'll start with the Nifty 50. And earnings actually are what have driven, one of the key reasons the markets have driven higher is because of muted expectations and better than expected earnings deliveries. 12.7% on the profits for the Nifty for the roughly 32 companies that have reported to date. 5.3% on the top line, not great, but the margin expansion has come through. And X Energy, 15% return profit growth year on year is much better than what the market was expecting. So that's been a key contributor to giving investors confidence and taking markets higher. We note that there was one adjustment. We typically make adjustments for non-operating one-time adjustments such as deferred tax items, etc. And we did that this time around for one company. Coming to the mid caps, the performance for the markets pretty much being led by mid caps. Impressive 21.2% growth on profits year over year. 23.9% X Energy, even better. And the top line is double digit, 11, 12%. So pretty decent performance by mid caps in what was considered to be quite a slow quarter and a challenging quarter. The valuations for mid caps trailing on reported companies to date have come down to under 30, and that's the trailing number. The forward number would be even lower, somewhere in the, we would guess, 26, 27 type range, coming close to what's being delivered on earnings. And very solid numbers being provided by this sector. Coming to small caps, the small cap profits and top line are muted. And the primary reason for that is the 27% weightage in financials for the small cap 250. And the profit contributions almost 41% from this sector. Now, most of the companies in the financials in the small cap space have delivered negative earnings growth or dismal, disappointing earnings growth, and also disappointing top line. So So that's being reflected on the index as well. But if we look beyond the index into sectors as well as stocks, the numbers are far better for many sectors, including consumer, healthcare, industrials, real estate, utilities, all have delivered strong performance, and individual companies are doing much better than what's being demonstrated by the index, which is why the index has also, the small cap index has also been performing very well. Coming to the other factor that has driven markets higher is the earnings surprise. And so typically it's the surprise that is usually the catalyst that takes markets higher. And that's the case this time too. 78% of companies in the Nifty have outperformed uh, versus analyst expectations. 66% have outperformed or exceeded analyst expectations on earnings. And for the mid cap, it's similar numbers, 77% and 64%. So a significant two-thirds of the universe that has reported across mid and Nifty, and to a lesser extent on the small caps, have delivered earnings surprises that have exceeded expectations. Coming to margins, again, we'll start with focus on mid caps, which have outperformed clearly, and it's being driven by an improvement in the gross margins, significant improvement in gross margins, improvement in the operating margins, and we anticipate as rates come lower, we will start to see improvement in the net profit margins as well. Seeing a similar trend coming through on the small caps as well, and a pickup in that trend of late, in particular on the gross margin. So look for earnings expansion to continue and come through. And same for the Nifty, we're seeing improvement in the gross margins and also fairly decent improvement in the operating margins. Finally, we look at earnings revisions to see what's coming through on company commentary for the future. And again, being led by mid caps, seeing a significant turnaround in the momentum on the 3 month, which is the dark red line, and the orange line is the 12 the year-on-year EPS revisions. So we're seeing a significant momentum pick up in the earnings revisions for mid caps, and that is what's been driving the earnings estimates higher for the forward 12 months for the mid cap 150. And same for the Nifty. The estimates have held firm after a very significant and solid delivery. Earnings have been stable, consolidating, and we think we look for these numbers to pick up as we move forward based on commentary given by many companies. That is quite positive. The revisions data also has bottomed both on the mid, the Nifty, and the small cap. Finally, beyond the Indian markets, we wanted to compare our markets very briefly across four factors with global markets. So we took the Nifty, the mid, and the small, and we compare them against the S&P 500, Nasdaq, Mag 7, Europe, emerging markets, Asia, China, Japan, Latin America, Middle East, Africa. And that's the x-axis on each of these charts. We'll start with earnings growth. Next year, next 12 months, next 2 years, expected earnings growth. And mid caps, Nifty mid cap, NSE mid caps are the top growth expectations, other than this one in Latin America. But for the next 2 years, it's Nifty and small mid cap and small caps. On sales growth, again, the mid and small caps and even the Nifty are amongst the best top line growth estimates of the universe that we're looking at, and better even than the Nasdaq, and in line with what is being expected from the Mag 7. And same in terms of looking at the PEs. The trailing PE on the Nifty is better than most of the growth markets we're comparing against. And the forward PE, while the trailing is high for the mid and the small, the forward PEs come down sharply over the next year or two. And so the terminal PEs over 2 years, let's say, are in line with what we'd see, or actually lower than what we're seeing with other growth markets like the Nasdaq and the Mag 7. And the cumulative factors we've looked at, the growth alongside the valuation, alongside the top line growth, our markets we would think are favorably placed versus some of the slower growth markets. Finally, looking at the PEG ratios, again, mid caps have the most attractive. Lower is better on the PEG, and so mid caps have the lowest PEG ratio amongst the growth markets and much better characteristics relative to other markets such as the S&P 500, the MAG, the Tech, Europe, etc. Finally, the flows. So as a result of the earnings delivery and the prognosis for Indian markets, domestic economy fairly insulated, safe haven, emerging safe haven relative to other regions which are saddled with humongous amounts of debt. Our markets are looking far more attractive, and also relative to China and other parts of Asia, and that's being manifested in terms of the flows. FI flows are back. DI flows are also have been solid and have picked up. And in terms of financialization trends, there's a whole bunch of data, but essentially SIPs have held up now 26,600 per month and have held solid throughout the slowdown we witnessed, and also the demat account creation may have marginally slowed down on the second order momentum, but remains in a solid growth mode. Moving on to the S&P 500 on earnings. 4.2% on the top line, 12.2% on the bottom line earnings growth. So very similar story to what we're seeing with the Nifty 50. Very similar numbers, slightly better for the Nifty on the top line. And then same sort of beat on muted expectations. 67% of S&P 500 companies have also beaten expectations so far, both on the top line and the bottom line. 307, slightly better on the top line. We wanted to also just look at the trend in terms of the Max 7. So first, the current quarter, the 9% top line growth, 28.3% bottom PAT growth. And what we're seeing is that the sales trend for the Max 7 has decelerated down to 9% year on year. But the companies have been able to also benefit or deliver margin expansion and deliver solid earnings growth, 28.3% year on year. Now the future estimates are quite muted, especially for the June quarter because of the lack of outlook. And then you see somewhat of an improvement in September, but we would not place too much. Nobody really knows how things are going to work out for the next few months in the US. And so that's what's being shown there in terms of the analyst expectations. So while there's been good earnings performance, the economy does have a fair amount of negative data that's out there, and that is increasingly likely to be the situation where we see a divergence between the corporate earnings, which are primarily led by the technology sector and the Mag 7 in particular, and the economy at large. And so we could see a divergence come through in between those two spaces. So just some of the data we share this most every month. This month, what we're witnessing is negative growth year on year on consumer credit. Only witnessed this in the grand financial crisis, and then maybe for a very short period of time during the COVID time. And the other somewhat alarming data point is the expectations for the financial situation worsening 1 year ahead. The polled individuals across age groups, I've shown you the 55 plus, but across all age groups, consumers are expecting their financial condition to worsen substantially, worsen or a substantial portion are expecting their financial conditions to worsen. And that is certainly not good in terms of spending, consumer spending. And then finally, our real estate market increasingly frozen as a result of the move in the interest rates. Coming to precious metals, gold continues to shine. And so the point we wanted to make earlier is that we continue to think gold retains a place as a strategic asset in portfolios because of its fairly correlated nature with debt. So I'm just showing US debt, but there's also Japanese debt, there's European debt, there's a significant amount of debt in the developed economies. and the prospects, and also the stimulus in China, the prospects for this to continue to grow seem fairly legitimate. And so we continue to believe that one should hold gold in the portfolio, and we are overweight gold since April 24th. The only other point I'll make this month on gold is the gold to copper ratio with respect to copper. So a significant, one can call an extreme bottom in this ratio, which suggests the huge outperformance of gold and the muted performance of copper. Maybe that is now changing. We've come to an extreme, and so that would be another sort of confirmation in terms of the bottoming on the commodity metals, which tends to correlate with bottoming in equity markets. We'll see how that goes. Now, more importantly, or more interestingly, we wanted to look at Nifty performance and gold performance, as well as S&P 500 performance during years when the dollar was weak and years when the dollar was strong. So the red bars are the bars when the dollar was weak. Not much. I mean, there's a fair amount of difference in the S&P, but a massive differential between the two categories for the Nifty. And 34%, 34.7% return during years that the dollar was down. And we could, take the time to go through the reasons why, but it's fairly self-evident. And same for gold. Very good years for gold when the dollar is weak and the US economy is weak. Finally, we'll just take a look at what's happening with earnings momentum. And the sectors that stand out, one is PSU banks, very reasonably valued, close to 1x book, seeing quite good earnings come through. And that is the reason why the revisions are starting to come through. Financial services as a pack are also typically tend to do well at this point in the business cycle with declining interest rates. So we're seeing that. We're also seeing a pickup in consumer, and that could continue into the next quarter and beyond as the tax cut kicks in. And then finally, from a cap perspective, we finally start to witness revisions in the small cap index, which has led to the stronger rally in the last few days, and the continuing positive revisions on the mid cap index as well as a pickup in the Nifty. So that's how we'd be highlighting in terms of prognosis, in terms of revisions for sectors. Okay, moving on to the macro tailwinds. We see a number of tailwinds that are likely to help in terms of earnings delivery into the rest of the year. One primary amongst them is low crude prices. Low crude and declining crude, typically very good for markets. And that's something we covered in last month's Know the Now. We also looked at low inflation and declining inflation. And so declining and low inflation is typically good for Indian equities. So again, another factor that's working in our favor. Declining interest rates. And so as we talked about earlier, we're looking at rates that are now approaching the lowest levels that we've witnessed in the last 15 years on rates. And typically low interest rates have preceded very strong rallies in the Indian equity markets. And so another macro tailwind that is working solidly in our favor. Finally, we're witnessing increasing money supply in the US. And we're also seeing similar sort of systemic liquidity improving in the Indian markets. RBI has been active. So that is another factor that is going to be working in terms of, as well as easing restrictions on credit that are going to be working in terms of tailwinds for the economy as we move forward. Just an update on our asset allocation. We trimmed our equity weights, started with mid and small in early October and large in late October, down to close to neutral. We then took those back up in March, very close to the bottom, a few days, 3 or 4 days post the March 4th bottom, and have been overweight equities during this entire period. We will look to add to our equity exposure as conditions permit, valuations permit, and clarity emerges on some of the global tariff-related and bond market-related issues. So our expectation is to be able to do this, raise our weights over the next 3 to 4 months, over which time we think we should have a better clarity in terms of go forward strategy in terms of the global markets and India's trade deals and the positioning within supply chains, etc. So we also have shared our tactical allocation in the note now with rationale. Feel free to take a look at those. Overweight equities, overweight precious metals, and underweight selectively positive on fixed income, and overweight on REITs and InvITs, selectively looking at opportunities in private markets. That's it from my side. Have a great month. Thanks for watching.